Hello, this is Elisabeth Troni from Cushman Wakefield. I'm here today to share some of my early thoughts on the unexpected news out of the U.S. overnight and the potential implications for commercial real estate across Europe. After months of an intense and unconventional campaign season that captured worldwide attention, America has finally voted and delivered a shock outcome with Republican nominee Donald Trump, now president-elect. The Republicans also retained the Senate, leaving them in control of Congress, a clean sweep. If the Brexit referendum was a toss of the coin, the outcome of the 2016 U.S. election was a toss of several coins. Trump had to win in a majority of battleground states, making the forecasting exercise much more complex than the in-out EU referendum. The uncertainty surrounding Trump and what he may represent means that risk assets, equities in particular, will take a hit in the short term. We are seeing this as markets open today across Asia and Europe. What has happened after Brexit, we suspect that stock prices will rebound once investors digest the shock outcome and realize the impact of a Trump presidency might be smaller than initially feared. But what does the outcome mean for commercial real estate? Our sector is not the stock market and doesn't experience wild swings or daily reactions. To look for implications from events, we often have to take a longer view. Looking first at financial markets, there are three main considerations. The first is heightened uncertainty and volatility, which does not always lead to reduced growth. The shock of a non-consensus event such as this is likely to result in increased volatility in the financial markets in the coming days and weeks. But as we have learned from other recent shocks, short-term volatility in the financial markets does not necessarily translate into any immediate or meaningful impact on the economy. Parallels will inevitably be drawn to the EU referendum. Brexit delivered an immediate shock, but since then, UK economic data has held up well. The US economy is on strong footing, and we expect should remain a leading source of global growth. Looking at currency markets, while the dollar normally strengthens in periods of uncertainty, we would now expect the Federal Reserve to take more time to assess its plans to raise interest rates, and that this would lead to a slight weakening. The drop in the dollar could initially provide a welcome backstop to sterling and the euro as they will strengthen against the dollar, but will ultimately be an additional challenge for the euro area as the central bank is running out of tools to support economic recovery, and a stronger currency won't help. Following on from the first theme of heightened uncertainty is an expectation of even more capital flowing into crowded European bond markets. This is a classic response of investors during times of uncertainty to seek safety in bonds. This should drive bond prices higher, yields lower, and provide further support to European real estate prices as they look an attractive alternative. Moving from financial markets to the European real estate occupational market, the key message is one of stability. Unless there is a material deterioration in economic conditions, occupational markets across Europe are not likely to change. Markets that are currently tight and experiencing upward pressure on rents will continue to do so, and soft markets will remain soft. Occupier demand across Europe was unaffected by the results of the EU referendum, and we expect will remain largely unaffected by the election of President Trump, particularly if global growth holds up relatively well. The London occupational market did take a bruising with Brexit, but we do not expect any direct impact from the US election. Finally, moving from occupiers to investors, three key themes emerge. Volatility drives a flight to safety amongst investors. A resurgence in core assets and market activity is likely, and limited deal flow for anything that has a fair amount of risk. We expect investors will rush some money into the European bond markets. This will create downward pressure on government bond yields, which will create new space for yield compression in commercial real estate, particularly for core assets. Admittedly, some European markets will look fully priced as yields trend even lower, but prices can overshoot for a period. Moreover, prime property has been acting as a bond substitute in recent years. With monetary policy likely to remain excessively loose, we see prime yields going even lower. With respect to the UK in particular, there is a possibility that investors will become less nervous about Brexit. The distraction of wider political uncertainty may level the playing field to some extent, or at least take the focus off Brexit for some time, which perhaps allows investors to realize that the fundamentals in London are still relatively robust. As and when markets settle, we expect investors will resume efforts to deploy the record-setting level of capital that has already been raised and allocated for European commercial real estate. To round up against a backdrop of short-term uncertainty, what can we focus on as signals that life will go on? What gave us a sense of normality after the EU referendum was a quick transfer of power and calmer views of a prolonged and uncertain exit. Unlike the UK political system, the US has a gap between the Obama and Trump administrations. Trump won't take office until the 20th of January 2017. Between now and then, we can expect him to try and calm markets via conciliatory speeches, starting with his acceptance remarks today, the nomination of key officials, and the setting out of his legislative priorities. Even with Trump's win and a Republican-controlled Congress, he is likely to find the legislative branch will dilute many of his policies, making the long-term differences between his and a Clinton administration smaller than they might appear today. Looking ahead, with a constitutional vote in Italy this side of Christmas and elections in France and Germany in 2017, there is much for us to be thinking about in European politics. I look forward to sharing my views on how these events might affect commercial real estate as soon as they happen. Thanks for listening.